Jose.
And I'm ready to go back. I'm not a fan of everything. So I hold and then there's
But that, you know, that mess with your brain. Oh, goodness. Hey, y'all. Why did it get so quiet all of a sudden? Hey, Tyler. Okay, and Zach. All right, let's jump in and get started, y'all. So I finally got feedback on everybody's pro forma. Some of you have got some little boogers. Okay, there's just some little issues that are really easily fixed. I'll give you an example of that. On your cash flow, some folks are taking this total cash inflows to mean all of these, right? All of those plus that. That's not what that means. These are inflows, right? These are outflows, cash inflows. So if I'm going to total up my cash inflows, it's not all of this, right? It's simply all of that, okay? And you'll see that in my formula. In each cell, the formula shows that it's those three cells immediately above it. Here's what happens. I know if this happened at least one time. If you sum up everything that's above it, okay? Whoops. If you sum up everything that's above it, I don't know why that didn't give me a number. Okay, if you sum up everything that's above it, it looks really innocuous, right? Because that 500,000 is correct. But when you copy that formula all the way over, look what happens to your ending cash balances. The number signs means that that number is so big we can't display it in that cell. So if you really take a look at what that means, you have to make that cell really wide. That would mean if I made that mistake, that error compounds so much. By the beginning of December, I've got $206 million in the bank. Okay? It don't work like that, y'all. Okay? So if that's you, okay? Others of you, I have noticed, and hey, Jake, why didn't y'all holler at me and tell me I needed to share my screen? I'm sorry. Okay. Others of you still don't have the correct number here in this beginning cash for your totals. In the total column, what's your beginning cash? It's 0, right? I know of at least one of you that has summed up all of these numbers for their beginning cash. It may or may not be somebody on a Zoom feed right now. Hint, hint, wink, wink, nod, nod. But remember, what we're shooting for is our December ending cash should be equal to our total ending cash. And if you don't have that right, that's the problem. Okay, so this thing builds on one another. Each assignment builds on one another, okay? So if you mess up and you get behind on an assignment, okay. I didn't know who was talking, if you were talking to me or. Okay, I'm sorry, I didn't hear you. What was the question? Okay, okay. So the problem is if you don't get the cash flow right before you move on to the income statement, then your income statement's going to be wrong. Okay, and it may be that in order to get that income statement right, you got to go back and fix the cash flow statement. Remember, when you're turning this in, I'm looking at what you're turning in for that week's work and for this week's work. It is the income statement. Now, I'm just noticing that there's some pretty serious problems, and I'm going back and taking a look at those, okay? And I'm just showing you some of the stuff that I'm seeing. But remember, this column is critically important. That totals column is the starting point for your income statement, okay? So a lot of these numbers that you see in this totals column reappear on the income statement. That $1.8 million there for sales, that number reappears. It's coming directly from your cash flow for sales. Your cost of goods sold, we shifted the position, right, and changed the label, but it's coming directly from your cash flow statement, and so on and so forth, okay? Some of you are losing money in your business, and I'm okay with that. Remember, this is about execution, not necessarily results. Okay, I want you to execute it correctly. I'm not grading you on whether you make or lose money in the business. What I'm grading you on is, did you execute the process correctly? Okay. However, if you're losing money in the business, understand this, please. I'm losing approximately $14,587 there, okay? If I'm losing money in the business, the question that you have to answer is, have I covered those negative operating cash flows? In other words, I need to make sure that this number here never drops below 0 and becomes a negative number, because I will grade you on that. And some of you, I mentioned, we need to talk about your negative cash flows, because you've got negative cash flows every month. Now, mine are kind of up and down, right? My ending cash is 87,000, 108,000, 130,000, 129,000. Then it starts to drop a little bit. It bottoms out at 25, and then it starts to come back up. And what's happening in these months? This is October, November, and December. My cash goes down in December specifically. Why? Because I've got to pay $29,000 worth of property tax that month, okay? So some of you got little love notes that said, hey, talk to me about your negative cash flows. I just would like to remind you, after today, we're only going to see each other 5 more times. Okay? 2 days next week, the 9th and the 11th. 2 days the week after that, the 16th and the 18th. And we may or may not see each other on the 23rd. Because remember, I've still got to give you that market research assignment, which is not going to be tough. It's just don't need to do it. Okay. So we may or may not even see each other on the 23rd. So we may only see each other 4 times. So if I sent you a love note that said, you're making good progress, but we need to fix this, please take me serious, okay? Because it's a lot easier to sit down face to face with your laptop or with my desktop. You can email me the file and we can work it out. Isn't that much easier as that? I mean, literally, you've been hunting something for how long? Didn't you come see me? No, it was Brian, I'm sorry. Brian, how long have you been hunting that when you came to see me?
Oh, I've been trying to fix it since the last class, or last time I worked on it.
And how long did it take me and you to fix it?
Well, 20 minutes or 15 minutes or so.
And most of that was talking. Okay. So at any rate, let's fix it before you get behind, because the more behind you get, the more time it's going to take to fix it. And the closer we get to that 23rd, which is the last date we're scheduled to be together, the more scarce our time is going to become. All right? Is everybody registered for their classes? No, because Ashley has not yet called me to schedule an appointment, right? Okay. If you haven't registered for your classes yet, you need to be doing that because classes are filling up. I just asked Seth, did you get everything that you wanted to? He said no, because international management is full. Okay. All right. Income statement. As I mentioned, okay, sales minus cost of goods sold equals gross profit. Gross profit minus operating expenses equals net profit. All I'm doing here is I'm putting in a subtotal, right? So for that, I probably really need to put an underline in there, okay? And then for net profit, just because that is kind of my bottom line, I'm gonna put a more meaningful double bottom line, okay? One of the things I want to start talking to you about right now is no dollar signs, no decimals, put in the thousands separator, okay? So just right now, go in there, select your data fields, format those cells. You want number format, 0 decimal places, use the thousands separator, okay? Number, no decimals, use the thousands separator. When I do that, y'all, look how much plainer and neater that lines up. Okay, that's after, that's before. Okay, before, after. It just lines up plainer. Okay, so be sure and do that. It makes it easier for me to grade. Remember, old eyes, grumpy dude equals bad outcome if it's difficult for me to grade. Okay. I noticed that some of you are very intelligent and you realize that I'm going to ask you to common size those statements. Okay, because I noticed that some of you have already put in a field, column that says common size. So since I saw that on your statements, let's go ahead and do that, okay? I'm gonna put in a column that says common size. And don't let that freak you out, okay? When I use the term common size, what I'm really saying is I want to compare the numbers to another number, okay? This is, it's where your industry standards will really come in handy, okay? On the income statement, we compare everything on the income statement to sales. Okay, make sense? We compare everything to sales. So for our common sizing, we want to compare sales to sales. That really doesn't make a lot of sense when you think about it, but it could make sense about this, okay? Sometimes on an income statement, you'll see it broken down a little more complex. You'll see gross sales less returns and allowances, okay, equals net sales. Right? Really, this number here is a net sales number. Right? It doesn't take into account any discounts that I might have given. If you're a business that wants to track the discounts and the returns and the allowances, let's say, for instance, that you worked at, I don't know, Dillard's. My daughter and I used to joke about my wife. She was really a JCPenney addict. I mean, she would order something from JCPenney, and we literally called her the queen of returns. She would take it back to JCPenney in a heartbeat. Okay. That information might be important to you. Any of you shop on Amazon? You've got a buyer profile on Amazon. And if you return too much stuff, they will shut you down. You don't think for a moment that Amazon doesn't have the ability to manipulate prices based on your buyer profile. What I'm saying is, if I search for something and my buyer profile is better than yours, in other words, I've returned less and I've given them less lip, and I've been a customer for a longer time. In other words, my buyer profile rates me more highly than you. You might look at the exact same item on Amazon Prime, and because your buyer profile is worse, you returned a greater percentage of product, and you've only been a customer for a short period of time, they might charge you more for the same product. And that's perfectly legitimate. That's perfectly legal, as long as they're not discriminating. There's nothing illegal about it. There's nothing even immoral about it. What are they doing? They're giving a preferred customer a preferred customer price. Any of y'all working over-the-counter sales, retail? I mean, do you get discounts in business? I know Specs does. Specs has their key club, right? You give us your profile so that we can market to you, and we'll give you a discount on certain promotional items. It happens every day in the real world. Okay? So I just simply say that when we're comparing sales to sales, it's not as simple as it seems in our example. In the real world, it might have a lot more applicability to you, because you may concern yourself with how much stuff do I have coming back, right? In other words, what's my return rate? Again, you want to compare to net sales, right? So to compare sales to sales, it's a very simple formula. Y'all watch this, okay? It's literally sales divided by sales, okay? Did you see what I did there? It's literally E7 divided by E7. However, I don't want to have to go down that stinking screen. I don't want to have to go down in every single row, right? I don't want to have to go down in every single row and put that formula in. So I'm going to make it a little easier for you. We're going to make this what we call a hard reference or an absolute cell reference. I'm not sure what they teach here. Have you heard that term before, a hard reference or an absolute reference? Okay. Are you familiar with this particular thing? If you put a dollar sign in front of the row and a dollar sign in front of the cell, it doesn't matter where you copy that formula to, it's always going to refer back to cell E7. Okay? So what is my formula? It's E7 divided by always E7. If I copy that formula down here, it's going to be E8 divided by E7. Here it's going to be E9 divided by E7. Okay, that's what we call an absolute reference or a hard reference. So watch this. When I copy that formula down, look at what happened. That's E8 divided by $E $7. This is E9 divided by $E $7, okay? And I can just copy that formula to my little heart's content everywhere that I want to have a common size value. Or I could just copy it all the way down and then go back and delete the ones that I don't need. Okay. And you see, I get a lot of decimal places, right? And I get a lot of decimal places. Okay. Really, what a common size is, it's a percentage. Okay. That one right there, what is that saying? It's saying that sales is one of sales. Can we restate that using a percentage? What would we say, Ashley? Sales is 100% of sales. So if we change our formatting here to percentage, okay, here's something I want you to do. Nowhere else do I want you to show me any decimal places, but here I want you to show me 2 decimal places. Okay. So sales is 100.0% of sales. Cost of goods sold is 60.8% of sales. Gross profit is 39.2% of sales. Okay. My rent, 13.69% of sales. That should be setting off an alarm bell for some of you who paid attention when we were talking about some of those rules of thumb or heuristics. You remember the heuristic that I gave you for your occupancy cost? The rule of thumb? It's okay if you don't, because I mean, I know we're drinking from a fire hose here. The heuristic that I gave you for occupancy cost is this. Your occupancy cost should be no more than 10% of your revenue. Look here, y'all. My occupancy cost is almost 14% of my revenue. You see that? This number is 13.69% of sales. Now, if I go apply that heuristic, there's 2 ways that that can work out. And this is why common sizing is valuable. Okay, stay with me here. This is why common sizing is valuable. I have a problem. And let me just encourage you to own your problems. Okay, I have a problem. Here is my problem. I am not efficiently using my location. That's my problem, right, Zach? I could try to make it my landlord's problem. And can you tell me how that would look? What it would sound like if I tried to make my problem my landlord's problem? What would it sound like? Drew, you want to take a stab at that?
You're charging me too much.
Yeah, pull your mask down and say that out loud so the people on the Zoom feed can hear you.
You're charging me too much.
Yeah, your rent's too high. Do you see the difference there? And that may be a problem, right? But the real problem is relative to what I'm paying for rent, my sales are too low. Okay? So how do I fix that problem? I need to grow my business. I need to increase sales, right? So do you see how we can use that type of information, what seems like a really specific and narrow piece of information, how we can apply that information to make improvements in our business? Okay. Now, quite frankly, you can try going to your landlord and saying, please, Mr. Landlord or Mrs. Landlord, I've got a good business here, I'm doing $1.8 million a year. But my rent is killing me. My rent's 13.7% of sales. I've done my homework. I've looked at my industry standards for furniture. Okay. If I can find it. Hope this is it. Furniture stores in the United States. This looks a little different than your report because of the age of it. I've done my homework. Okay. And here's what I have found. Cost structure benchmarks. Rent and utilities in the furniture business really should only be about 7% of sales. Can you work with me? Because I'm doing everything I can to grow our business. I'll make a deal with you. I'll pay you 10% of my sales as rent. That's the proposition. That way, you've got some incentive to help me grow my business. And I've got some incentive to grow my business. And I really don't want to move because I think that's a great location. But now you've informed yourself with some power, right? Okay. Here's your power. That's the industry standard as of 2012. It's 8 years old now, right? The industry standard for rent was 7% of sales, and that's actually rent and utilities. Okay. But if we can get my rent down a little bit, I can actually be profitable. You see, Mr. Landlord, the way it is right now, I'm not profitable. And my banker tells me that if I'm not profitable, that he's not going to loan me any money. And y'all remember our discussion on Monday about loans? If I'm not profitable, it's not just that he's not going to loan me any additional money, but he put a covenant into my loan agreement that says if I'm not profitable, I have 30 days to pay off my note. And if I have to do that, then I'm going to not only default at the bank, I'm also going to default on my lease. And I know that we signed a 5-year lease, but I also understand that a personal bankruptcy would eliminate that debt. Please, Mr. Landlord, don't make that possible. Don't make that necessary, right? Do you see how you've got a little information to go back and negotiate? That's where the value comes in. Y'all, that's where the value comes in doing common sizing. Okay. That's where the value is on common sizing, is knowing what's broken so that you can fix it. Okay. You may also take a look at your commission sales. Well, there's a reason I'm only selling $1.8 million a year, and that's that my employees are not very motivated because I'm not giving them enough upside potential. And as you're redoing your performance statements, you're doing your discovery, okay? As you're doing your statements, we have a theory. I have a theory that if I increase my employees' compensation from 20% of the gross to 30% of the gross profit, that they'll sell twice as much. In other words, I'm letting my employees participate in the upside potential. The more they sell, the more they make. I'm going to give them a really high compensation, 30% of their gross profit on every sale. That comes with a really high expectation, right? It means that we need to double sales, okay? So let's just do this, y'all, okay? Commission sales. I'm going to change that from 20% to 30%. Okay? And I'm going to change sales. I'm going to multiply all of my sales times 2. Okay. So instead of having 1.8 million in sales, I must have missed one of the numbers, but I got 3.24 million in sales. Now let's look at my income statement. Oh, by doing that, my rent is now only 7.61% of sales. And look at my net profit. Instead of losing money, do you see what happens? Now I'm making a cool $250,000. Now, I just asked you, does that or does that not sound like it would be a valuable tool when you're a manager in a business that's charged with P&L responsibility, right? But in order to get that kind of decision-making power, you have to have the right analysis tool. So don't freak out a little about the comment side, because all we're doing is we're comparing one number to another number. That's all those financial ratios that we talked about on Monday are. They're just comparison of 2 numbers. And I understand, yes, I'm standing up here with a 4-inch fire hose and I'm aiming it directly at your face. And that's no fun. Here's the good news. You got another couple of years, okay, to learn all this stuff before you get out of here. Except for you, Mike, and you, Ashley. You're out of here. Jose. So you have different lines for sales, right? And one, you had a comment, you had a love note from me, right? That says, I don't know where your sales number comes from. Here's what I was really saying with that, okay? You can break out your sales by line if you want to, because what he really has, refresh my memory, he's got product sales, you've got memberships, monthly memberships, and then do you charge a visit fee? Per visit fee. So he's got 3 different lines, right? 3 different revenue lines. His question is, can I just combine those? Yeah, sure you can. You can combine those and call them all sales. Let me tell you a real story. Here's a real story. The other business that I commonly do when I'm running through this exercise, I relate back to a client I used to have. Guy's name is Lance Lansky. He owns a Line-X dealership, a Line-X franchise in Valdosta, Georgia. I used to just do that one because it makes a lot of sense, and I deal with that same issue because in a truck accessory and bedliner shop, right? Think of 4-wheel performance, right? They sell accessories, but they also do like suspension upgrades. Okay? Or for an automobile shop that sells parts and labor, right? Okay. Lance started that business and he had a great job. I mean, he literally wanted to be his own boss, but he had a really high cost of entry because he had a sales job. He was a VP of sales and making $200,000 a year. So I said at the very beginning, Lance, are you sure you want to do this? That's a pretty big pay cut. He said, yeah, I'm tired of making the man the money. I want to do it for myself. Okay. He said, so we need to figure what this business is going to look like. And I said, you're going to have truck accessories and you're going to have bedliners. You need to break those out. He said, why? Doesn't matter. I'm going to pay for either one. I said, you need to manage your margins on both of those. He said, what's a margin? Okay. Guy making $200,000 a year. VP of sales. Didn't know what margin was. I said, so here's the thing. Bedliners and truck accessories are 2 very different products. A bed liner, you take essentially paint, although it's a really snazzy kind of paint for Line-X. It's actually a compound process that flash dries when it contacts. Okay? It's kind of one of those chemical things that'll make your children be more naked without hair. You don't want to get into it. Okay? But he's taken that out of a 55-gallon drum, right? And spraying it on the truck. And the end result is he sells a completed bed liner. Okay? That's completely different than selling somebody's grandpa a fiberglass topper. Okay? Or selling somebody a set of Nerf bars, or a set of LED lights, or a set of wheels and tires. And he said, well, I see what you say, but I mean, we'll sell them all. So how's it really different? I said, what's your cost of goods sold going to be on those bed liners? He said, I don't know. So, well, let's look at your franchise disclosure documents. And we decided that 35% of sales is about the right number. Okay. So roughly speaking, a bed liner would sell for $475. He's got $150 in materials. Okay? That's the chemicals that he sprays. Really good margins, right? $475, I got $150 in costs plus labor. Well, that's not like a $325 margin on every bed liner I sell. That's pretty darn good. You do 3 or 4 of those today, 5 of those today, you make real money. Now let's talk about Grandpa's fiberglass topper. You know Grandpa can buy that online, right? I said, yeah. I said, and you know every customer that buys it from you is going to price check. They're going to be what's called showroom. That's a very specific process. That process means that they come to Lance and they look at what the options are. They decide what they want, and then they order it from Amazon or Rock Auto or whoever it might be. And they're simply shopping on price. They're using your showroom to get the information, but then they're buying it on price. I said, so Lance, you don't mean to hurt your feelings, but your cost of goods sold on your truck accessories is going to be probably 80% of sales. That means you're only going to have a 25% markup on that. Compare that to having a 70% markup. He said, yeah, that kind of sucks, doesn't it? I said, okay, so you need 2 revenue lines. Help Lance set up his QuickBooks file. Things are going okay, except he's losing money when he starts. I said, okay, dude, are you recording, like I told you, your truck accessory sales and your Line-X spray and bed liners separate? Yes, sir, boss, I'm doing just like you recommended. I said, are you recording your cost of goods sold separately? Are you recording your cost of goods sold for your truck accessories separately? Well, you didn't tell me I needed to do that. I said, oh, well, we did. See, here in your chart of accounts, QuickBooks, you've got 2 different cost of goods sold. If I just lump it all in the cost of goods sold. I said, okay, so I see you've got 2 problems. Number one is the mix. You thought you were going to sell a lot more bed liners, but you actually wound up selling a lot more truck accessories. That's one problem. So you're selling the low margin product rather than the high margin product. But I think you may have another problem. Step out here to my truck. I wasn't just a consultant part, I was also a customer. I said, I don't know if you've seen this. I bought this truck. I traded with you, or traded with the dealership to add it into the purchase. I said, yeah, I'm going to spray a bed line. And the dealership paid it, and I brought it to you, and your guys did it. I said, but Lance, dude, this thing is like crazy. Yeah, they say Line-X is military grade, and that's one of the selling points. I mean, when the Pentagon was hit in 9/11, when they built it back, they sprayed the walls of the Pentagon with Line-X for blast protection. That's how durable this stuff is. I said, but man, I just can't imagine, even though it's a Chevy, I can't imagine that this stuff needs to be that thick. And he said, man, you're right. I said, did your guys maybe spray a little extra on there because it was me, because they see me in here every month? He said, yeah, they might have. I said, how do they know how much is enough? He said, I just tell them to do a good job, and they do a good job. I've never had any complaints. I said, what are the specifications for lines? And he said, we've actually got a micrometer we're supposed to measure every bedline. There's a specific number, and it's in thousands of inches. Like over the rails on a truck, they used to didn't have those plastic bed caps on all the trucks like they do now, but over the rails of the truck, the spec is it's supposed to be 85 thousandths of an inch. Over the rails of my Silverado, it's a quarter inch. On the tailgate that takes all the wear and tear, it's about 3/8 of an inch. In the bed of the truck, it's supposed to be 50 thousandths, 1/20th of an inch thick. It was about 3 times as thick as it was supposed to be. And on the sidewalls, which really don't take any wear and tear, it's supposed to be like 5 thousandths or 3 thousandths or something. And it was more than double. I said, Lance, here's your problem. You're telling your guys to do a good job. And I have no doubt that they want to do a good job. They don't want anybody to come back and complain, because that makes them look bad. They didn't do a good job. It makes you look bad. It hurts customer impressions of you. Have you ever had a deadline come back? No, I've never had anybody complain about the quality of our deadline experience. Damn right. But what if your cost of goods sold on deadliners is 3 times as much as it's supposed to be? That bedliner that you're selling for $475 instead of costing you $150 is now costing you $450. And they said, well, I get your point. I understand. I said, here's the deal. Okay. We need to break this out. So I made him go through every transaction the previous year where he had recorded cost of goods sold for his bedliner, for his material. And it wasn't 3 times as much, it was twice as much. But that was enough to flip the thing, right? If he does 3 bedliners a day and his cost of goods sold on every bedliner is supposed to be $150, but instead his cost of goods sold on the bedliner is $300, that means he's got $450 worth of product driving away every day that he's not getting paid for. Not only is he not getting paid for it, but he's also not getting the margin on that, right? 3 bedliners, 5 days a week, $150 a pop is over $100,000 a year. I mean, just do the math on that. 450 times 5 is 2250. Okay, 2250 times 52 weeks in a year. Okay. He said, man, you're a genius. I said, no. What it boils down to is information is power, right? Okay. Is that cool? You see how you can apply that information? Now, I know I made some changes in there in my assumptions. Anytime that you do something like that, make sure that you go back and fix your assumptions, right? And specifically what I did was I doubled my sales. So I need to change the assumption that I'm going to average $150,000 a month to I'm going to average $300,000 a month. And I need to change the assumption that I'm going to pay my commission salespeople 20% to paying them 30%. And yeah, more than likely, I probably need another delivery team. Since I doubled my sales, I'm probably going to double my delivery costs, right? So that means I need to buy another delivery truck and I need to hire 2 more workers. So I won't see all of that money fall to the bottom. But you can see how it can help you to manage your business. Okay. That doesn't answer your question, but I just told you why it's important. All right. Short answer, I don't have a problem with it, Jose, if you lump the 3 lines together. Okay. When you show them on your cash flow, you're going to show joiner fees, membership fees, and product sales. That's going to be on your cash flow. When you show it on your income statement, it's going to be sales. And you're going to add those 3 things together. Does that make sense? Okay. That's the income statement, y'all. The next one is the balance sheet. Okay. And it's actually balance sheets. Okay. So I add a tab. Who wants to give me the fundamental accounting equation? Jake, are you there? Lintera, are you there? Hey, you are there. Actually, I'm gonna have to have the same conversation again, aren't I? Lintera, do you remember the fundamental accounting equation?
General assets minus liabilities.
Right, that's the one I'm talking about. Assets equals liabilities plus equities, right? Or you could state it differently like you did, assets minus liabilities equals equity. The reason we state it as assets equal liabilities plus equity is that's our balance sheet equation, right? That's the reason we have the preference for stating it that way. The rest of it's just algebra, okay? So on our balance sheet, we're going to use that fundamental accounting equation. Up top, we're going to have assets. We're going to give ourselves some room. Then we're going to have liabilities and equities. Okay. In other words, if we had an equation for that, it would be assets equals liabilities and equities, right? Now, y'all remember way back from when we did that little hot dog stand assignment that there's different types of assets. We talked about those, right? Current assets, fixed assets, I don't know what it was, other assets, okay? So we need to break these down. On the balance sheet, we list them in their order of liquidity, okay? Current assets come first. Fixed assets come next. Other assets come next, okay? And by the way, since we've now broken them out, we need to bring them back together, okay? So we're going to have total assets, okay? Underneath our liabilities, we have very similar categories, right? We have current liabilities. And you remember the definition of a current liability is a liability that has to be paid within the next 12 months. Then we have long-term liabilities. That long-term liability is what's paid outside of the next year, okay? That's the only 2 kinds of liabilities we have, current and long-term. So we next need to total those up, okay? And by the way, I'll just put this in here. I'm inserting a row. The bigger heading is liabilities and equities. The heading underneath that is simply liabilities. And then I have another heading here that says equity accounts, right? Okay. Similar to my liabilities, I'm going to have a total equity account. And down here at the very bottom, I'm going to have total liabilities and equities. Okay. By the way, is it proving helpful for y'all for me to upload this video?
Yes.
Okay, good. Probably a lot more helpful than this is, right? Okay. All right. So all I did was I just laid out my format there. Okay. I said we've got our assets up here. This is all assets, right? This area is going to be dealing with assets, but I just said we got some current assets, we got some fixed assets, and we got some other assets. Okay. Then I'm going to bring all those things together. Okay. This section down here is liabilities and equities. Okay. Under liabilities and equities, I've got some liabilities and I've got some equities, and then I'm going to total those up. Okay. And the secret is the balance sheet must balance. You remember the hot dog exercise, right? The balance sheet is always going to balance. Every single transaction that you ever do in business is going to be reflected on your balance sheet. Okay. It gets a little more difficult. Remember, there's two balance sheets. There's opening day. Okay. And there's end of year one. I'm just going to name that EOY 1. EOY meaning end of year one. Okay. That's the two balance sheets that you have to do. Remember, the first one, the opening day balance sheet is 25 points. End of year one, 50 points. Okay. So we're going to have those kind of parallel balance sheets. Okay. Let's drill down a little more. What are current assets? Anything that gets turned into cash. He said quickly, I heard it again. Okay. The term current has a very specific definition. It's within the current accounting period, which is a year. Okay. So anything that gets turned into cash within a year is a current asset. So would that include cash? Okay. You better hope you can turn your cash into cash within a year, right? Otherwise, you probably need to have a conversation with your banker. How about your inventory? You remember I told you that I have 104 days worth of inventory? Oh yeah, that'd be another assumption that would have to change, right? Inventory. Since I have 104 days of inventory and 104 days is less than 365 days, all of my inventory is a current asset, right? In other words, I'm turning my inventory about 3.5 times a year. Okay. I don't have any accounts receivable. This is a cash and carry business. Okay. I'm not running any charge accounts for my customers. That's what accounts receivable are. If I sold a sofa to Rianne on credit, okay, and she came to me and made payments on that, that's an accounts receivable. I ain't doing that. Okay. And very few businesses actually do that themselves now. I mean, if you go to Johnson Furniture and Mattress, I can show you, I've got a Johnson Furniture and Mattress credit card, but I don't make payments to Johnson Furniture and Mattress. It's a private label credit card that's handled by Synchrony Bank. What happens? I make a purchase on that credit card. Synchrony Bank gives Johnson Furniture and Mattress the money, and then I make payments to Synchrony Bank. Okay. So you're not going to have any accounts receivable. Okay. Those are the three most common. Okay. You may sometimes see cash and marketable securities, but don't worry about that. Okay. Those are the only two current assets I have, so I want to do total current assets. Okay. What are fixed assets? Furniture and fixtures and equipment. It could also include land and building. It could include machinery. It can include my delivery vehicle, right? Those are all fixed assets. Now, specifically, I have to refresh my memory. I have delivery vehicle and furniture, fixtures, and equipment. I can go back again and look at my sources and uses of funds, right? Those are the only two fixed assets I have, delivery vehicle and furniture, fixtures, and equipment. Bless you. Bless you too, okay? So on my balance sheet, what kind of fixed assets do I need? Delivery vehicle. Okay, I'm gonna skip a line. In fact, I'm gonna put in some more lines. Okay, I'm gonna skip a line. Remember, I called furniture, fixtures, and equipment F, F, and E. I'm gonna skip another line. And I'm going to put in net fixed assets. There's a very specific reason that I'm using the term net fixed assets instead of total fixed assets. When I use the term net, what does that mean? Difference, right? There's a minus sign in there, okay? And what do we subtract from the value of our delivery vehicle and from the value of our furniture and fixtures and equipment? Accumulated depreciation, okay? So delivery vehicle minus accumulated. Now on the income statement, we call it depreciation expense. But on the balance sheet, we call it accumulated depreciation because we keep a running total of that through the years, okay? Okay. Now do you see why I have net fixed assets? Should be net fixed, F-I-X-E-D, okay? Because what this is going to mean is I take the cost of my delivery vehicle and I subtract my depreciation expense. I add the cost of my furniture and fixtures and equipment and I subtract my depreciation expense, okay? You see how that's net and that's different than total? Okay. For other assets, in the interest of time, y'all just please take my word for this, okay? I have some very specific other assets. First among those is the security deposit with my landlord. And maybe a security deposit with my utility companies if I go to that level of detail, right? Now, why am I considering that an other asset instead of a current asset? Because really what this is it's cash that's held by my landlord, right? When do I get that back? If I satisfactorily leave my lease. It's conditional, right? If I break my lease, I don't get it back, okay? But if I go the full term of my lease and I leave the property in at least as good a shape as I found it in, what happens? I get the money back. You see how it's long term, right? Because it's signed a 5-year lease. Plus conditional, okay? Now the other one, you know, you could argue that we'll make a case, put it up there under current assets, but I like to just kind of make the point of what this really is. Something we're going to call prepaid expenses, okay? Y'all remember those 7 categories of fixed cost, right? Utilities, salaries, advertising, insurance, interest, rent, depreciation. What does the term prepaid mean? I paid it before I started, right? And if you'll look at my cash flow, Do you see where I paid some expenses before I started? Specifically my property insurance, my workers' compensation, and my grand opening advertising. So I paid over $39,000 worth of prepaid expenses. Okay, we got to account for that money, so it's going to show up on the balance sheet, and we're going to call that a prepaid expense. Okay. Now we'll use the term total again here rather than net. Total other assets, right? Because we're simply adding those two things together. Okay. And then we have our total assets. Let me ask you a question. Would you rather me work through this right now and populate this with numbers, or would you rather me continue down to liabilities and equities with talking you through them? Which is easier for you? Somebody's got to take their mask off. Go back up. Curious. Go on to liabilities and equity. Okay. All right. So under liabilities, we have current liabilities, right? In the normal scheme of business, we have things like credit cards. And really, a credit card is, by definition, current liability. Your creditor is extending credit to you with the expectation, but not the hope that you pay it off immediately. Okay? Remember, what does that creditor want to do? They want to keep you their servant, right? But they make it so that you can pay it off every month. And guess what? If things get sideways, they're going to close your account. They're going to close your account. They're going to tell you that you can pay it off before December the 1st, or whatever the date is. It has to be like 60 or 90 days in advance, because they have to give you time to do it. And if you choose not to pay it off, then your penalty APR goes up to 35.99%. Okay. And it's a current liability. Credit card's a current liability. You really should treat it as a very current liability, just in life. Okay. I'm blessed. I don't carry a balance on credit cards unless they are foolish enough to give me 0% APR for an extended period of time. Okay. You should pay it off every month. What else does a business have that they have to pay off every month? You remember those payroll taxes? I put a stipulation in there in our assumptions that payroll taxes are 11.15% of sales, and they're paid immediately. Okay? Somebody, and I don't remember who, instead of multiplying their payroll times 0.1115, multiplied their payroll times 11.15. In other words, their payroll taxes are 11.15 times as much as their payroll expenses. I don't remember who did that, but please fix it. You got to love note. Whoever did it, I don't know. Okay. Please fix it. That should be 0.115. It's not really a current liability for us, because when do we pay it? Immediately. Okay. So sales tax payable. I'm not going to keep track of that, and here's why. When I collect money from my customer for sales tax, that's not income for me. It's not even revenue. I'm simply a trust agent. The Texas Controller of Public Accounts very graciously gives me until the 20th of November to pay all of the sales tax that I collected in October. And I'll have till the 20th of December to pay all of the sales tax that I collected in November. Okay? But technically, yeah, you could put sales tax payable. There is one that does apply to your business. See, all those things I just talked about, we're not worried about for you. I want your assignment to be simple. Okay? there is one that you do have to worry about. You remember that loan we got? That loan, I believe, go back to my assumption, or to my loan amortization, it has a 5-year term. Okay? So here's the deal with that loan. I'm making monthly payments every month. Remember, it's fully amortized. That means I make monthly payments every month. A portion of that goes to principal, a portion of that goes to interest, and there's a point out there in the future when the balance is blessedly zero. Okay? It's fully amortized. Here's the deal. It's not all a long-term liability, even though it has a 5-year term. Part of that loan has to be paid back in the current accounting period. What did we define as the current accounting period? A year, the next 12 months, right? Okay. That portion that I have to pay, the principal of that I pay in the next 12 months, has a very specific name. Start typing now because it's long. Net current portion. I'm gonna wait till I stop hearing keys. Net current portion of long-term debt. Net current portion of long-term debt. So Mac, actually, y'all have sort of been around for a little while. You're graduating. Have you ever heard that term? I talk about it in the simulation, right? Because here's the deal. If you take out a 10-year loan, a portion of that loan has to be paid in the first year, and the rest of it has to be paid in the next 9 years. And the portion that has to be paid in the next year affects your current ratio. People say, well, why don't I take out a 5-year loan? Because the interest rate's 0.5% lower on a 5-year loan. The problem is your principal is twice as much each year on a 5-year loan. So that affects your current ratio, right? You know, just imagine if you had a 0% interest loan for 5 years and a 0% interest loan for 10 years, the payments on the 5-year loan are going to be twice as much, right? And we need to treat that as an obligation that has to be paid within the next year. Why do we treat it as an obligation that has to be paid within the next year? I love it when y'all give me a smart answer. Come on, somebody give me a smart answer. Why do we treat it as an obligation that has to be paid within the next year? Because it is an obligation that has to be paid in the next year. Right? It's the net current portion. It's the portion of our loan that's going to be paid in the next 12 months. Okay? That's the only current liability that you're going to have. Okay? I'm going to abbreviate it. Okay? You potentially in the real world will have credit cards, sales tax, payroll tax, accounts payable. If your vendors are ever foolish enough to give you credit, right, you would have an account payable. Okay, I'm going to abbreviate this NCP of LTD. And no, that is not a Ford that your granny used to drive. Okay, that's my only current liability. But they're paid when?
Oh, sorry.
Yeah, I mean, you actually do have payroll taxes, but remember that assumption that I gave you? When are they paid? Yeah, okay. All right. So do you have some long-term liabilities? Say yes. Okay. And we'll call that note payable. Now, here's what I really want you to know about that note payable. Remember, part of it has to be paid next year. a bunch of it has to be paid outside of next year. Okay, so the portion that has to be paid outside of next year is actually our new pay. In other words, we have to here account for our current portion. Right? Because the note payable is going to be the total amount that we borrow. The net current portion is going to be the amount that we pay back in the next 12 months. Okay? So our net long-term liability is going to be our note payable less, you can abbreviate this, NCP of LTD. Okay? So we've got our note payable less NCP of LTD. Okay? And remember, since we're saying less or minus, right? That's going to be net long-term liabilities. Okay? All right. So our total liabilities is just going to be our current liabilities plus our long-term liabilities. Okay? Let's get back to our cash flow. I put some money into this. Owner's investment. You remember that? Okay. So on my balance sheet under equity, remember, we got owner's investment. Okay. For bonus points so that I can tell you to have a good weekend. Who remembers the other place that equity can come from? Profit. Okay. We've got our owner's investment. Okay. We've got our earnings. And where does equity go to? It gets distributed to the owners. Okay. When we distribute it, we call it an owner's draw because my business is a sole proprietorship. Your business may vary. Okay. I'm going to say less owner's draws. If you're a partnership, you would call that partner's distribution of capital. If you're an LLC, it really depends on how you're taxed. If you're taxed as a proprietorship, it's still an owner's draw. If you're taxed as a corporation, distributing money to your owners is called a dividend. If you're a corporation, it's called a dividend. Okay? Okay. This is really redundant, so I'm going to eliminate those two lines. And I'm just going to rename that where I said total equity accounts. I'm going to rename that net equity accounts, right? Because it is a net. I take my investment, I add my earnings, I subtract my draws. That's a net, right? Okay. And the good news is I don't have to do anything for my total liabilities and equities. It's just a sum. Okay. It's kind of like total assets is a sum of current, fixed, and other. Okay. Total liabilities and equity is simply a sum of liabilities and equities. Okay. All right. So now that we've done that, let's put in some formulas. Okay. This says total current assets. Can you help me with the formula there? I'm going to put a bottom border under it. Okay. Can you help me with the formula there? What is total current assets? It's going to be cash plus inventory, right? Okay. Our delivery vehicle minus accumulated depreciation plus our furniture and fixtures and equipment minus accumulated depreciation equals our net fixed assets. Okay, so I'm going to put a formula in there. Okay, my net fixed assets equals the delivery vehicle minus depreciation plus furniture, fixtures, and equipment minus depreciation. Make sense? Okay. My other assets, I'm going to simply add those up. It equals security deposits plus prepaid expenses. Okay. I'm just putting formulas in, y'all. That's all. My total assets equals current assets plus fixed assets plus other assets. Okay. And since that's kind of a grand total, I'll put a double bottom line there. Okay. The rest of this is just playing hide and seek or whatever you want to call it. If I wanted to know how much cash I have on opening day, where could I find that out? My cash flow, specifically where, Drew? So I'm going to put a formula in, okay, that says go over here to my cash flow statement. How much cash do I have on opening day? I could say this beginning cash for January. That's valid. Or I could say ending cash for pre-startup. Okay. So my formula simply says equal, go to my cash flow, whatever is in cell D32, bring it over. Okay. Equals cash flow D32. What about my beginning inventory? What about my inventory? How much inventory do I have in opening day? There's going to be a pattern, y'all. It is on my cash flow, isn't it? That's going to equal from my cash flow how much my beginning inventory is. Okay. So my total current assets are $390,701. Okay. Where can I get the value of my delivery vehicle? And yeah, you could get it there, but I'd rather see you go to the cash flow. Okay. You always want to get it, and there's a reason for this, okay? You want to get it from the most recent place it appears. Okay. The most recent place that that delivery vehicle appears is on my cash flow. Okay, so I go to my cash flow and I find my delivery vehicle, 35,000. Okay, my furniture, fixtures, and equipment, same thing, cash flow. Okay, let me ask you just a reasonable question. On opening day, have I recorded any depreciation expense? So what goes in accumulated depreciation? It's a zero, right? What's my net fixed assets? It's 50,000. Okay. My security deposits, where can I get those from? If you said cash flow, you're correct. Okay. Remember, that's 1 month's rent. What about my prepaid expenses? If you said cash flow, tell them what they won, Drew. Is your property insurance, your workers' compensation insurance, and your advertising. Okay, those are the 3 prepaid expenses that I have. Okay, now look at this, y'all. I've populated these with values from my cash flow. Do you see how much my total assets are? It's $500,000. Just because Drew brought it up, if I look at my total sources and uses of funds, do you see how much it is? Oh, okay. Starting to make a little sense now? Okay, going back to your balance sheet. Let's put in some formulas. Okay. Your total current liabilities. Let me go down here, put that double underline and then make it go away. Okay, so I'm gonna put in my underlines first. Okay. All right. So here, your current liabilities, very simple formula, right? The only current liability we have is that one. Okay. Our long-term liabilities, if I'm getting the net, wouldn't that equal my note payable minus my net current portion? Okay. And then my total liabilities simply equal my current plus my long-term. Okay. My net equity accounts is going to equal my owner's investment plus my earnings less my draws. Okay. And my total liabilities and equities is going to equal my total liabilities plus my net equities. That's just formulas, y'all. Okay. Watch what happens. Okay. Is there a place where I can go find out what the net current portion of my long-term debt is? It's not obvious, but it's there. Watch this. Put equal. Go back to your cash flow. Do you see your principal here? What's your principal? Your principal is the amount that you're paying down your loan every month, right? Okay. So if I sum all of those things up, would that equal the net current portion of my long-term debt? Fortunately, because there's a total column here, I don't have to sum them all up. All I have to do is say, go to my totals column and get the principal for the first 12 months. Okay. 66,301. How much is my note payable on opening day? That's on the cash flow. It's 375. Okay. What's my net current portion of my long-term debt? Interestingly, here, all I have to do is say, go up there and get that number. Okay. What's my total liabilities? It's 375. What was my owner's investment? Where can I find it? It's the cash in, right? Owner's investment. Have I earned anything at this point? No, because I haven't made a sale. Have I drawn anything at this point? No. Okay. And look at here, y'all. It's magic. My total liabilities and equities, 500,000, equal my total assets, 500,000. In other words, you remember Lentera gave us that formula, that fundamental accounting equation? Assets equals liabilities plus equities, right? Okay. I didn't get as far as I wanted to. I wanted to have the end of year one balance sheet. So here's what I'm going to do. First thing in the morning, I'm going to upload this video. I'll also create another short video that says, this is how you do your end of year one. Okay. Your responsibility is going to be to do both of them to turn in by Sunday night. And if I forget to put the work in process number 4 available to you, feel free to jack me up. Okay. Send me a text and say, dummy, you did it again. Okay. All right. So save. Okay. I'll upload these videos first thing in the morning for you. Okay. You can watch them and you'll be able to do both of your balance sheets. All right, fair enough. Have a good weekend. Stay safe. I don't know what our COVID numbers are today, but they have not been kind to us over the last couple of weeks. So let's hope we've peaked. Y'all stay safe. Bye, Jake. Bye, Lentira.